Hi, everyone. Thank you so much for joining us today for Macro Matters, even for fundamental managers, using risk models to measure macroeconomic risks. I'm Courtney Scharf. I'm going to be your moderator for today's webinar. I'm the Global Head of Partnerships here at Qontigo. I'm responsible for managing and developing our strategic partnership relationships here. Very quickly, Qontigo and Omega Point have actually been partners for just over 4 years now. We began our relationship in 2017 when Omega Point first integrated our US and our worldwide equity risk factor models. Since then, we've continued to expand our relationship, and it has flourished, and Omega Point has actually integrated now our full suite of equity risk factor models. I'm very excited to introduce our two presenters today. We are joined by Melissa Brown and Kevin Wahlberg. Melissa Brown is the head of applied research here at Qontigo. She is responsible for developing unique insights into risk trends by consolidating and analyzing the vast amounts of data available on the market for portfolio risk. Prior to joining Qontigo, Melissa was actually the managing director and head of the institutional business at Wintrust Capital Management. Before that, she spent 10 years at Goldman Sachs Asset Management, most recently as a partner, actually, in the Quantitative Investment Strategies Group. She was also previously the director of quantitative research at Prudential Securities, where, among other things, she popularized the idea of the cockroach theory of earnings surprised and appeared on Institutional Investors' all-star list for 10 straight years. Kevin Wahlberg is a product specialist at Omega Point. Kevin previously worked as a multi-asset class risk specialist at FactSet, selling risk models and solutions to asset owners, hedge funds, institutional asset managers, insurance companies, and wealth firms. In his prior role with FactSet, Kevin worked as an analytics consultant, collaborating with a wide array of clients to build, streamline, and enhance quantitative research, risk, and performance workflows. So we're very excited to have both of them with us today. Just a couple of administrative points before we begin. Hopefully everyone can see the Q&A box on the lower right-hand side of your screen. At any time during the presentations today, please feel free to add questions or comments into that box there, and we'll address those either at the end of one of the presentations or at the end of both of the presentations, depending on the nature of the question. I'll be keeping an eye on that as we go through. We're also going to be doing a couple of poll questions in the presentation. You can click your response directly into the presentation to weigh in, and then we'll be getting the results live in real time. So that's it from me, and I'm happy now to turn it over to Melissa Brown.
Thanks, Courtney, and thanks everybody for joining us. First, let me just go through a quick agenda. I'm going to give an intro to the Axioma Macro Projection Model, just talk a little bit about the nature and underpinnings of the model. And then I'll turn it over to Kevin to talk about some practical applications focused on exposure and risk analysis, performance attribution, and portfolio construction. And then we'll open it up for Q&A, and we hope you have a lot of questions. So let's just get started here. This is our first poll question. And just a simple one, do you use a macroeconomic outlook in your choice of assets and your portfolio construction? So if hopefully you're seeing this poll and can start to answer, and we will just give it about 30 seconds and then go on to see what the answers are. Hopefully, yes or no covered the range of possibilities. Okay, let me just give this another 10 seconds or so. Get those votes in. Okay, so let's see. Oh, okay, interesting. So almost 3/4 of you are using some kind of macroeconomic outlook in either your choice of assets or your portfolio construction or both, and about 1/4 are not. Okay, that's actually really good to hear. Hopefully the presentation will help enhance your ability to use those economic outlooks. So let's just start with the intro here. So some of the key features of this macroeconomic projection model, which I will be calling the macro model from now on, just to save some syllables there. The idea behind this model is to explain factor return. So many of you are familiar with fundamental factor models that use that have style, industry, country characteristics that are used to explain risk. So what we're doing in this model is basically taking our standard model where we have these various type of risks and in projecting macroeconomic factors onto these fundamental factors. And so you can see in the two charts here, we have the risk breakdown of, this happens to be of a low risk portfolio. On the top, you can see the breakdown according to the standard model, where much of the risk in this portfolio was attributed to style risk. But on the bottom, when we do this projection, you can see that about half of that style risk can actually be attributed to macroeconomic factors. So one of the really key points to note is that we have a consistent risk prediction across the two models. So you're going to get the same total risk, active risk, breakdown of factor and specific risk. The only thing that changes is the decomposition of that risk. And so the risk is decomposed into the macro risk, and then the residuals to that macro risk of styles, industries, and countries. And then, as we have in the standard model, there's also currency risk and specific risk. So, just to keep that in mind, that it's the risk decomposition and then, therefore, performance attribution that's going to be different between the two models. So basically, how do we do this? Well, the idea is we want to start by explaining factor returns, these style and industry and country returns, through the lens of these macroeconomic factors, plus whatever is in that style or industry or country that's residual to that macro factor. So in other words, what's kind of unique to the style factor. So, as I mentioned, we have a different decomposition of the risk. The standard model looks at, market risk, style, industry, country, currency, and specific. In the macro model, we have the risk is now made up of the macro risk, the styles, industries, and country risk that are residuals to that macro, and then also the currency and the specific risk. When we think about what the macro factors do a good job of explaining, it's really more of market-related factors. So something like what we call market sensitivity, which is also kind of a beta factor. How sensitive is a particular stock to movements in the market? That is actually going to be much more highly correlated with macro factors than other more fundamentally based factors, let's say a profitability factor, which is going to tend to be much more unique to a specific company and less to, let's say, the macroeconomic environment. And again, I guess we keep emphasizing this. We have consistent risk predictions with our standard model. So you're going to get the same asset level risk and portfolio level risk, and the only thing that's going to change is the factor risk and decomposition. So just to give a basic overview, by the way, if anybody is interested in the mathematics behind how we do this, I think one of the slides at the end will go through some more equations. But I think, basically just understanding that we regress macro factors on these other factors hopefully will help describe the model well enough. So Here, these are just some sample use cases. First of all, we think about the use cases in terms of risk analysis and risk decomposition on an ex-ante basis. So what are my exposures to macroeconomic factors? That can be important. Which are the biggest factors that I'm exposed to? And, importantly, I think, can I hedge those exposures? If I'm very exposed to oil prices in my portfolio, I can hedge that if I want to. I may want that exposure, but it's nonetheless good to know that I have it. We can also use this model in performance attribution. So take a look at how economic factors impacted returns. Did they have a big impact on returns? And certainly this year we've seen some very big impacts of these economic factors. The chart on the right shows just a performance breakdown of the Stocks Global 1800 Index. And you can see that, right at the end here, for example, commodities have always had a positive impact on the return of the index, starting in 2020 and extending into this year. They've had a hugely positive impact. On the flip side, the GBP-based BBB corporate spread, starting in 2020 and extending into this year, had a highly negative impact on the return. And that can be very helpful to know if you can, whether you're using that macro forecast in your portfolio construction or not, you may very well have macro exposure. And so this can be helpful in knowing how that has related to performance. We can also just look at how these economic factors related to style factor returns. If you're a style-based manager, that may help explain some of the style returns, which may have gone in the opposite direction to what you would have expected, for example. Third use is in portfolio construction. For example, if you are running a back test, you can see what the impact of hedging some exposure, some macro exposure that you didn't want might have been. Plenty of ways to use this model. We think, certainly this year with all the news about macro factors, inflation or term spreads or credit spreads, this seems particularly important for what's going on this year. But I think, in general, every year there's been some macro impact on performance. And again, just here, the methodology, so we've just regressed the factor returns. We get a beta to that factor for each style, industry, and country factor. We then use that in the covariance matrix. So how do we, that's how it ties into the risk prediction. We keep currencies separate. And again, just to kind of hammer home this point, risk can now be viewed as what's explained by the macro factors and what's explained by the residuals. Just one last point for me to make here is, what are these macro factors? These are all of the factors in the model. We look at term spreads, defined as the 10-year minus the 6-month yield. And we're looking at the changes in that. And we do that for 4 currencies, dollars, pounds, euros, and yen. We look at credit spreads based on the 5-year node of the BBB credits, or the credit curve, again, in those same 4 currencies. We look at break-even inflation, and again, daily changes in that break-even inflation. Here we don't use yen, just dollars, pounds, and euros. We have 3 different commodities that we look at. So non-energy commodities based on returns of the spot index. Gold, looking at the GSCI spot index again, and then oil, looking at 1-month oil futures. It's important to note that we're just using market-traded factors other factors such as GDP, unemployment, other factors like that, CPI, which are not daily traded factors, are not included in the model. And there are a number of reasons for that. So with that, I'm going to turn the mic over to Kevin to go into a little more depth about the application of this model.
Great, thanks, Melissa, and appreciate the introduction and the solid background on the model. As you can tell, this macro projection model has really been a very exciting new perspective and lens for us to be able to provide a new perspective on all of the analysis that we do in Omega Point. And for the purposes of today's demonstration, as Melissa noted, we're really going to touch on three key overarching themes of the analysis. So that starts with portfolio analysis, which is really understanding macro's influence on our portfolios through the lens of historical performance attribution, predicted risk analysis, as well as exposures. The second piece is, broader market research. So understanding and providing context to the broader global equity landscape, as well as macro factors behaviors in the market. And then the third piece is the portfolio construction side. So this is really taking that new information set, marrying it with, the fundamental analysis that we're familiar with, and then using that to better inform our decision-making when it comes to portfolio management. At this point, I'm going to switch from the slide view to a screen share. If you're able to, in the presentation, in the upper right-hand corner, toggle your view, and you should be able to then see my screen. So here, before we start to dive directly into the macro projection model, I did want to provide a quick overview of just what this portfolio looks like through the lens of the core fundamental worldwide model. Now, for the purposes of this demonstration, we've created a sample global long-short strategy in which to analyze. This is going to give us a real-world example of kind of how our customer base can leverage this model in their analysis. So looking again through the fundamental model, we could see that over the course of the prior 17 months, so from the beginning of 2020 until the end of May of this year, the portfolio has seen a positive performance of 602 basis points. Now, if we want to decompose that through the lens of the model, we can see that that gets separated out between our factor performance, so our factor contribution, meaning that the factors can explain about 390 basis points of that positive performance. The residual, or the alpha, is really the idiosyncratic value that our stocks have provided above and beyond those common systematic movements in the market. And if we want to get a slightly more detailed view into the factor side, we can look here on the right-hand side and see our top and bottom style factor contributors. So on the plus side, we start to see familiar factors like medium-term momentum, size, leverage, et cetera, that are adding to our positive performance. And then on the detractor side, we see things like volatility, value, market sensitivity or beta, and growth. So again, these are the familiar kind of building blocks around the fundamental model workflow. But what we have the ability to do is, again, kind of expand that content set, that information set to the macro landscape and provide additional perspectives and detail on how those macro factors are actually driving performance, risk, et cetera. As Melissa noted, and I will continue to beat the dead horse, so to speak, but the top level performance and risk measurements that you'll see between the fundamental and the macro models will be consistent. All we're doing is changing the ways in which we decompose those numbers at the factor level. So looking over the course of the same time frame now through the macro model, we still see that 602 basis points of positive performance. However, now when we look to start to decompose that, the factors in the macro model are starting to explain a lot more of the positive performance. So we see about 740 basis points coming through this model. Now, to get a quick sense of really what's driving that and how that differs from what we were seeing in the fundamental perspective, we start to notice things like, the oil factor, US dollar corporate spreads, and gold are really driving up a great degree of positive performance. And then on the flip side, we see inflation as a standout in terms of a factor that's really dragging down a lot of our performance over this time frame. Now, as we can see, these are wide swings in the portfolio, and we really want to understand where those are coming from. So to take a deeper dive, what we'll do is we'll jump across and start to look at the trends of this performance over the entirety of that 17 months to really get a more granular picture of not only what factors and how, but also where in particular. Are there particular time frames? Are there particular securities that are really contributing most to this? So again, we're looking at this same time period, but what I'll do now is I'm going to open up the macro section and start to take a look at what influence the macro factors have had over this 17-month period. And immediately we see a few standouts, right? We look at oil here in orange, where we've seen a massive spike, around the onset of the COVID pandemic. And then since that point, we've actually seen a slow bleed in terms of its impact on portfolio performance to date. On the other end of the equation, we have the inflation factor, which again, we saw in our overview as a large detractor. And this has been a little bit more of a steady decline on the portfolio, resulting in ultimately a little over 12% in terms of a negative detraction from our performance. Now, it's important to understand, again, how the factors impact the total return of the portfolio, but we also need to understand the why, right? What types of exposures do we have to these factors that will allow it to translate to these large swings that we see and the impacts that we ultimately realize? And for that, I'm going to switch here to our exposure view. Now, these are the portfolio's exposures to each of the macro factors. So let's highlight oil, as we saw that was a major contributor to our positive performance. So looking at the portfolio's exposure to the oil factor, we've been consistently underexposed to oil, although that's been fairly mitigated when we think about things relative to where our exposure was in early 2020. Now, you might be thinking, looking at the y-axis on the left, that negative 17 basis points at its peak may not seem all that significant, but unlike the familiar z-score methodology that we're familiar with around some of the fundamental style factors, these factor exposures to macro factors can actually be interpreted as beta exposures. So when we look at something like a negative 17 basis point underexposure to oil is a very volatile factor. So something like a 30% move in oil at this exposure level would actually have around a 5+% impact on the portfolio's return. Now, if we shift our focus to inflation, you'll see the scale will change, right? Inflation is a slower moving factor, but our beta exposure is significantly higher in terms of magnitude. Now, this one has been, in terms of exposure, has really been widening unlike the oil exposure. So we were relatively neutral at the beginning of 2020, but that's changed dramatically over the course of this period. And where we end up at, at the end of last month is about negative 5.5 in terms of an underexposure. Now, what that would mean relative to what the example that we provided with oil is that about a 1% return in the inflation factor would have around the same impact as that 30% move in oil. So it's always important to understand kind of the different scales and the different volatilities of the factors that exist here. Now, again, we're kind of taking things one step at a time, right? We understand the performance that's being derived from these macro factors. We understand where our portfolio is positioned in relation to these factors, but where is that exposure coming from? In this case, I'll continue to pick on inflation here. And within Omega Point, we have the ability to drill down to the security level, whether that's across exposures, performance contributions, predicted risk contributions, et cetera, and many other places. In this case, I'll take a look at our exposure contributors at the security level. And if I flip this sort to the names that are contributing most to this underexposure, we see that we have a significant short position here in ExxonMobil. And that's really driving a lot of our underexposure to this particular factor. Now, I have the ability to launch a single security view if we want to kind of drill further into specific names and understand, what's the DNA of this name as it relates to the macro environment. If I take a look at the macro exposures for this particular name, we can see that inflation, for example, was relatively low, right? Back at the beginning of 2020, and then through the beginning of kind of COVID and thereafter, we saw a large spike in the degree of sensitivity that Exxon has to inflation, where it almost triples in size. So this is, again, a name where we'll see kind of a great deal of sensitivity to inflation. Inflation has certainly been at the forefront and in the spotlight and will only continue to be so. So understanding kind of where our sensitivities are coming from and how we're positioned will only better inform the portfolio management process and the portfolio construction process. So we've looked briefly through, again, portfolios, historical performance through the lens of macro factors, our exposures. Now, how does that translate into our ex-ante or predicted risk? If I shift our view here, we can see that the blue line is going to chart our predicted risk, which is synonymous with the forecasted annualized volatility. Now, we can see that naturally spiked around March or April of last year and has since kind of come down to where it stands now at about 14% annualized. Now, where is a lot of that coming from? If we look at kind of a high-level factor decomposition view, we can see that this green line denotes the percentage of our overall predicted volatility that comes from macro factors in aggregate. So back in March of last year, we actually saw that more than half of this portfolio's predicted volatility was coming from macro factors. Now, that has since decreased as sector factors have started to kind of take over the reins here a little bit, but we still see a great deal of macro influence at about a quarter of our predicted volatility coming from our macro factors. Now, this is also in terms of absolute analysis. So just looking at the portfolio's absolute return in isolation. But what we can also do is if we wanted to understand quickly, well, how does this portfolio stack up relative to the broader global market? We can quickly toggle to add a global benchmark. And what we see here now, when we start to think about how we might over or underperform the broader global market, macro still plays a much more significant influence in that. So macro is really going to dictate how much or how little we over or underperform on a relative basis when we think about the future. So shifting the focus a little bit, again, the first pillar that we really wanted to talk about was the portfolio analysis piece. So understanding macro's influence on our portfolio, but there are a lot of other aspects of our macro analysis that we can get into. So the second side that we wanted to jump into is more of the research side. So kind of outside of the context of the portfolio, let's understand the broader context of the equity landscape, and let's also understand the macro factors in isolation as well. So to do that, I'll start from the factor side. So right here, again, we're looking at the factors disregarding the portfolio that we've been analyzing. These are the factors in their purest form from directly from the risk model. And quickly we can see from a performance standpoint on the right-hand side, what factors have outperformed and which have underperformed over a given time frame, in this case, a trailing 12-month period. Now, if we want to get additional details into any of these particular factors, we can easily click in. So let's take gold for an example. Now we can see here that the gold factor has been on the rise as of late. And when we think about that in the context of gold's history, what we can do is we can look at our normalized return trend at the bottom. Now, what this does is it really measures a factor's performance relative to its own history. And we can chart that in terms of standard deviations above and below the mean. So we see here that gold is trading fairly well above its historical average. And if we actually extend this period out, what I'll do is I'll actually take this all the way back to 2007 so we can get a much broader scope. Now you can see that through time, the factors will tend to deviate, right? They can move up or down outside of that bounds away from its mean, but factors do have a tendency to mean revert. So what this can do in conjunction with your own, macroeconomic projections and foresights and analysis, this can better inform your risk tolerance levels. So how much you're willing to take on from a given factor, or where you might just need to take, an additional look under the hood to understand really the underpinnings of your portfolio and where these risks are coming from. We can also see on the right-hand side, lists of ETFs that are both positively exposed and negatively exposed to any particular factor. Now, we've been focused a lot on inflation, as we saw that was, not only a hot topic in the market today, but it's also been a heavy influence on the portfolio that we've been analyzing. So when we look at the names, or the ETFs rather, that have a high degree of exposure to inflation, we're seeing a lot of energy, a lot of concentration in energy, and in oil and gas as well. So, this is a trend that we've seen recently, where during this inflationary period in this macro-driven environment, we've seen a lot more of an influence of inflation over energy. Now we can easily continue to drill further, right? If we want to look at, let's say, our global energy ETF. If we take a look at the degree of risk that's coming from our macro factors, and more specifically, actually, our inflation factor and oil factor, which we're focused on, we see a bit of a shift, and I'll extend this back a little bit for better viewing. But you can see that oil was really the dominant force in terms of explaining the volatility of the global energy sector. Now that really, there's somewhat of a changing of the guard here when we go back to March of 2020, where oil's influence actually came down quite a bit, and the inflation factor actually started to explain a lot more of the movements within energy. So again, these are important insights to understand from a research perspective that we can relate back to the portfolio for the purposes of portfolio management and construction. So I'll shift the focus a little bit again. So rather than focusing purely on the factors from the macro model, what we can also do is look at things from a broader equity landscape. So using Omega Point's security screening tool, our security search, we can actually whittle down a broad universe of investable securities based on both qualitative and quantitative filters, and then take that output and better analyze those. Now, this could be for a number of different purposes, right? We could be doing this for idea generation, if we're looking for individual, stocks or ETFs to invest in. This could also be for broader market research. It could also be for constructing a thematic basket or a hedge basket for which to potentially increase or decrease some of those factor exposures that we see in our portfolio. So in this case, I've set up a simple screen here. Let's say that we're looking for US stocks with particular trading volume and market cap constraints. And for the purposes of our portfolio, let's say that we're looking for anything with an inflation exposure greater than 1, so that beta exposure. Now we see that about 664 securities are passing this screen, and from there we can pull in all of the relative details that we'd like to take a look at. So whether those are exposures to the macro factors that we've been focused on, as you see here, they could be top level, risk decomposition metrics. They could also be any other unique content sets that Omega Point integrates into our platform. So whether those be related to ESG or fundamental characteristics, or even proprietary research content directly from our customers. Now, ultimately, again, because this can flow into really any piece of the portfolio management and construction process, what we can then do is take the insights that we glean here, whether those be high inflation names that we may want to add to our portfolio that we agree with fundamentally. We've done our due diligence, and maybe they have the added benefit of also, knocking down that negative inflation exposure that we hold in the portfolio. Regardless of what that is, we can actually move this to the portfolio construction workflow in a number of different ways. Now, there's a whole host of different avenues that we can take for portfolio construction in Omega Point. Today, I'll really focus on two. So the first of those two is going to be trade simulation. So within this environment, we can again shift the focus back to our sample global long-short portfolio that we've been analyzing. And in this case, I could take a look at my macro factors. And in this case, I'll take a look at the exposures, the exposure contributions therein that are coming from those underlying names. And what we can do in here is we can really start to play with different trade ideas. So whether that's resizing existing names, if it's adding new names, and we can do those in conjunction. So you can add as many as you want and start to see the impact that has on the portfolio's DNA. So let's say, for example, that we want to focus on the short side of our book, and we want to take a look at the names that are contributing most to our underexposure in inflation. Again, we see the familiar Exxon. Let's say that, for example, we realize that we're taking too large a stake for what we're comfortable with here in this name, and we want to trim our short exposure down. So we'll be short 3% just as an example. I can submit that trade, and immediately what you see is now we have at the top our original portfolio, our new rebalanced portfolio with that trade applied, and then the deltas across the board. So we can see the impact that that has on our total predicted volatility through the model, a slight reduction there of 60 basis points. We can also see what impact that has in terms of our exposure to particular factors. So on the inflation side, for example, we've actually increased our exposure to inflation through that one trade by almost 60 basis points, which really brings that actually back closer to zero, given the fact that we previously and still have an underexposure to the factor. Now, again, we can continue to iterate through whether that be trading additional names, resizing, or adding new names to the portfolio. And regardless of kind of the outcome or the end goal of these experiments, we actually have the ability to save these down so that you can then compare and contrast with not only your original portfolio, but also additional experiments, right? So this can become an iterative process where you have the ability to really quantify the value in the trades that you're looking to implement. Now, the trade simulation is much more of a user applied approach, right? But what we can also do, if we want to take more of a systematic approach to a rebalance or an optimization of our portfolio, we can do so through Omega Points Optimizer as well. So here, what we have, and we can see toward the bottom, this is where our current portfolio sits relative to the efficient frontier. Now, our optimizer can take in any forecasts that we want, any particular constraints that we have around turnover, maximum trade sizes, et cetera, along with factor exposure constraints as well, to try to find a portfolio that will maximize that risk and return profile of the portfolio. So we see here with a relatively unconstrained optimization that our original portfolio had an expected return of about 533 basis points, whereas the optimizer was able to boost that to 892 while keeping our total risk consistent. So that maximizes our Sharpe ratio. And what we also see is that it really increases a lot of the specific or idiosyncratic risk in this particular strategy, which really kind of dampens the impact of systematic factors and allows more of the alpha ideas to thrive. But again, we have the ability to iterate on this, right? So maybe there are particular constraints that we want to be aware of. And I know that we've really seen a lot of the inflation influence, and I know that this is top of mind. So let's say that we wanted to take inflation and we wanted to get our exposure, which is currently at -5.5, and we want to move that closer to zero. Now I'm willing to give it a little bit of wiggle room, and let's see what the optimizer comes up with now. So the optimization will actually rerun now with this factor exposure constraint in mind. And now what we'll get is an entirely new portfolio, the same statistics that we saw before. So again, we're keeping our risk consistent, we're maximizing our expected return, we're increasing the degree of specific risk that we have in the portfolio, so the influence of those of alpha or potential alpha on our portfolio's future return. And we can even see the trades therein. So what does the optimizer want to do, right? What does it want to buy? What does it want to sell? What does it want to short? What shorts does it want to cover? And this is really an area where, again, we can go back and say, these are really large swings. The optimizer wants to buy a lot of a particular name. We can go back and add trade constraints to kind of mitigate some of that as well. So all of this is to say that we have the full capabilities from your portfolio analytics all the way through to research, and then rounding that out at the portfolio construction and composition phase of the workflow. And the macro model really gives us the ability to do that in a much more holistic way with new and exciting perspectives on that analysis. So with that, I will pass the baton back, and I believe we'll be opening it up for our Q&A portion of the presentation.
That's it. Thank you so much, Kevin. That was great. And yes, we do have a number of questions coming in. So thank you all for submitting those. I'm going to go ahead and get started with our first question, which is from Melissa. How do you think about the horizon over which the linkage between macro and style/industry is measured? For example, value is known to vary with macro cycles, but over business cycles, not necessarily on a monthly, quarterly basis.
Yeah, and thanks for that, Courtney, by the way. I think the answer to that lies in the fact that, we are looking at the betas of these factors, of the macro factors, to the fundamental factors. And when things change, the beta is going to change. But if things aren't changing, then we will see a consistent beta. So presumably over the course of a business cycle or a value cycle, the relationship between, let's say value and term spreads is going to be fairly consistent, or that exposure for any given name is going to be fairly consistent. For other factors, you may actually have more, or a shortened cycle, something like market sensitivity, which can kind of change around a lot more. Then we will see, relatively more turnover in the exposures.
Awesome. Thanks, Melissa. And just a follow-up question for you. Do you use any liquid proxies as substitutes for macro factors, some of which may be reported at lower, maybe quarterly frequencies?
We do not use any of those liquid substitutes. We only use market-traded factors. So, related to interest rates or break-even inflation or commodity prices. I think there's a couple of reasons for that. One is they're not necessarily particularly good proxies. And you can, by the way, you can also create proxies for these data that are reported at lower frequencies. But I think a bigger problem is that they tend to be revised so much. Things like GDP or even inflation is going to be revised so much. What you would have to use in the model is, kind of the data as reported, which is, kind of a little bit tougher to come by. But then you also have to take into account, like, what happens when the data is revised. And that's, I think that's much less straightforward. So we've just chosen to use these, the higher frequency or, daily traded data.
Great. Thanks, Melissa. And Kevin, a quick question for you. Is the web platform the only way to access the data on Omega Point?
It's a great question. It's not the only way. Omega Point also has an API that we expose to our customer base as well. So that could be for the purposes of really any of the three key themes that we discussed. So whether it's looking at your portfolio analytics, if it's pulling, macro data and factor model data, as well as kind of the construction of the optimization or hedging tools that you'd like to explore. So we have a lot of customers that are using that heavily right alongside us. And that's really a way that we provide a lot of value around kind of seeing this in different ways and really applying it in new and unique ways as well.
Awesome. Thanks, Kevin. I've got another question from Melissa, more about the model. So the question is, since the market factor is no longer included in the regression with the macro factors, what then would be the interpretation of factor returns? For example, market sensitivity, momentum, growth value. This person asks, can we still make the statement that a 10% year-to-date return on momentum is relative to the market?
So when, in general, when we're talking about total risk, we do actually the same transformation on the market factor, the market intercept factor. So we are applying this this economic data to the market as well when we're talking about total risk space. In active risk space, it's going to be zero anyway, and in that case, we could say that the 10% year-to-date return on momentum, should we see that, is net of the market. So, and by the way, I just want to also point out, I know we don't have a huge amount of time, so some of these questions, these really good questions that you're asking, may require a little bit of a deeper dive, and so we're happy to take those up offline and just make sure we can really get your questions answered. But just to give a, so.
Thanks. Yeah, thanks, Melissa. We're happy to organize some follow-up sessions if you guys want to talk one-to-one with Melissa or Kevin, or anybody from the Qontigo or MegaPoint teams. We're happy to make that happen. So absolutely. And there's a lot of good questions coming in. Melissa, I'm gonna direct this one at you, but Kevin, if you also want to jump in here, this question says, this model places more emphasis on explanations from macro factors. So why would those be deemed as more important than fundamental factors?
So as Kevin and I kind of repeated a lot, we're not really changing the relative importance or the contribution to risk from the fundamental factors. We're just kind of recasting them in terms of the macro factors. So we're not saying macro factors are going to explain more returns than fundamental factors. Because it should be exactly the same when you get to the aggregate level of factors. What we're saying is that macro factors are explaining the returns of fundamental factors. And so you've got the fundamental factor return that's essentially divided into its idiosyncratic return, if you will, or its residual return, and then its return that's related to the macro factors. So I wouldn't say the macro factors are more important than the fundamental factors. They are just, and another thing I would point out is that, I think, Kevin showed this in many of his charts, the exposures change over time. The returns, the contribution to return changes over time. So, for example, this year, break-even inflation has probably been a much more important driver of the returns of, say, the market sensitivity factor or other fundamental factors, and maybe of industry factors as well, or even of country factors, than, say, it was 2 years ago. So there's also kind of a relative, a time element to the relative importance as well.
Perfect. Thanks, Melissa. And a quick question for Kevin. Do you have other clients using the macro model within their hedging process? Is it possible to do this with a MegaPoint?
Yeah, thank you for the question. So that would be a yes to both of those questions, and I'll dig a little bit deeper on that. So we do have customers that we've started to work with from a macro perspective in terms of identifying and building custom hedges. Now, the idea here is to build and create hedges that are much more fit to the portfolio strategies that we're looking to hedge. If we think about, a lot of times, long short managers might use, generic ETFs, broad-based ETFs like SPY or the Qs in order to kind of hedge out some of the market risk in their portfolios. But what our platform allows us to do is to really build a much more targeted and specific hedge that takes into account really any factors that you're looking to really target or focus on. And that's inclusive of the macro factors. So whether that be to create an inflation hedge, or if you wanted to create, a broader macro hedge or something specific to commodities, we have the ability to do that in the platform, and then leverage our network in terms of actually, implementing that, in the portfolio as well.
Great. Thanks, Kevin. And I'm going to jump back to Melissa quickly. A question, are there regional versions of the macro model?
Good question. Right now, there are not regional versions of the macro model. The factors, we believe are more global in nature. And so perhaps we don't need a regional version, but I could see where that might be interesting. Let's say potentially in Europe, where maybe you have some kind of carbon factor, because that becomes very important in for companies, in not only in their reporting but probably in their actions. So, adding at least some regional versions is probably sitting somewhere on the research agenda, but not at the top of the list.
Perfect, thank you. Okay, another quick question for you, Melissa. The question is, Greg Conner published a paper that shows fundamental factors explaining about 80 to 90% of the R squared. Are you saying that things have changed?
No, we're not saying that things have changed. And obviously, we believe very strongly in the importance of using fundamental factor models. What we're, just digging down one layer, what we're really saying is that macro factors explain some of the fundamental factors. Not that they necessarily explain more of the risk than fundamental factors, but just that they explain those fundamental factor returns. That also seems like a question that might be good to address offline as well.
Great, happy to. And then another quick one for you, Melissa. Is the macro model also integrated with multi-asset class risk models?
On the Qontigo platform or the Axioma platform, it is available to be used as part of our multi-asset class product. Yes.
Perfect. And this is maybe a question over for Kevin. Kevin, what kind of manager would ultimately benefit maybe from using this?
Sure. Yeah. I mean, I think that is a broad landscape. Obviously the macro focused managers are going to see a lot of value in terms of the intuition behind some of the bets that they're taking to a lot of these macro factors, right? But I think that what we've started to see is an increased interest in more adoption from more of the fundamentally focused managers as well. And that could be really in any landscape. So whether that's, hedge fund managers, traditional asset managers, absolute or benchmark relative, it's really just enhancing the information set that we have and complementing the core fundamental analysis that is really central to their workflow to be able to provide, again, kind of more ammo or more tools in the tool belt to be able to better manage their strategies.
If I could just add to that also, I think even a quantitatively driven manager can benefit from this. That was one of the reasons we asked that poll question at the beginning. Even if you don't use any kind of macroeconomic forecast or input, you're still affected by the macroeconomy. And some types of strategies are more affected than others. A low-risk strategy, for example, tends to get much more, when we do that breakdown of factor risk, it tends to see much more of its risk from macro factors than, say, a quality-type portfolio, which tends to have much more stock-specific risk, for example. So I think, so even if you're not using this kind of input, it can be helpful to know about it. And I think another thing I would add is even if you are using this, sometimes the risk breakdown doesn't always reflect things like, correlations. And so it can be helpful to just ensure that you are actually getting the exposure that you want to get. So just to add my 2 cents there.
No, thank you so much, Melissa.
Out of time.
We are. Yes, we are out of time. So I know we didn't get to everyone's questions today, but thank you so much for joining us. Hopefully you found this helpful and insightful. If you are looking for more information or we didn't get to your question, please feel free to reach out to us at partnerships@Qontigo.com. And I will be happy to direct your question to Melissa, to Kevin, to someone at the Omega Point team or someone here in Qontigo. Again, that's partnerships@Qontigo.com. But again, thank you so much for joining us. And we look forward to speaking with you all soon. Thanks again.
Thanks.